Hey, happy Mortgage Monday, fun day, and I hope you had a great start to your week. I'm going to jump right in with the market update. We finally did get a bit of a break on mortgage rates last week when that 10-year hit a critical level, which sent the mortgage rates down, which you already know. I've already said it to you. It's old news, and I'm sure everybody's told you, but this did happen after that CPI report really pushed us in that direction. So, better news on inflation will hopefully reverse some of the recent increases. Obviously, it won't put us into some sort of historically all time low rates in the near future, but at least it will hopefully give us a little bit of relief. So we've get our buyers and sellers a little more comfortable, thinking, okay, great, it's coming back down reasonably. And I'd love to help you lead a buyer seller in that direction if they need to hear it from someone else besides you that we are still doing good. Now, as far as some upcoming news, we're all going to be watching and waiting to see what the Federal Reserve does on July 26th. So, as soon as I know, I'm going to let you guys know. You'll probably hear it, but we'll all be waiting to see if they decide to take a pause or do another rate hike. Again, that's July 26th. So, we'll find out what they do then. But for today, we are holding fairly steady since, or where we, from where we ended on Friday. We did have one improvement, but it's really just pretty leveled out. And today's current average interest rate for the typical 30-year purchased fixed rate loan is about a 7.18%. If you've got someone who's curious on what they qualify for, as always, send them over. I'm happy to have a conversation with them and let them know what they would qualify for. Now, for the rest of this video, I want to take some time and talk about 2-1 buydowns. We still got a lot of people who are interested in buying right now, but would love to know what a 2-1 buydown would do for them. So I'm happy to explain that to anyone. Like I said, the 2-1 buydown is still pretty popular. They'll be able to take that seller concession, and whatever the market rate is today, they can obviously take advantage of a lower rate for the first 2 years. Example, we're at a 7.25% today. They can have that first year at a 5.25 and then the next year 6.25 before it fully corrects at the 7.25. For them, that money is actually held separately in sort of an escrow. So all basically that seller concession pays the difference. So what that payment would have been a 7.25, the difference of the temporary rate, it covers that. So what if the buyer refinances or pays off within that 2 years? That money is not lost. It is sitting aside. And if it doesn't get used within those first 2 years, it goes back to them in the form of a lower payoff. So if they decide to take advantage of, some sort of refinance or like I said, payoff, they get that money back. No biggie. I don't expect you to have to explain that, but at least you kind of know. And if anyone's curious, send them my way. I'd be happy to give them that same info and break it down.